Good afternoon, everyone. Thank you for joining us. We're just going to wait a few moments while we see some people in the wait room here before we begin. Can you just put a thumbs up in the chat if audio is working? Want to make sure you guys can hear us. Perfect. Thank you so much. And just a reminder, this webinar will be recorded. So if you do have to leave for any reason, don't worry. We'll try and get to out shortly after to you. And please put your questions in the Q&A section down below, and Shaf will try and get to as many as he can. We did get quite a bit of questions emailed in too, so he'll definitely be going over those. And I see there's still some more people in the wait room, so we'll just give it a few moments. And just a reminder, before we do begin, please note that today's presentation and webinar may include forward-looking statements within the meaning of applicable securities laws. These statements reflect management's current expectations, but are subject to risks and uncertainties that may cause actual results to differ materially. For a complete discussion of risk factors, please refer to both VST and Hydreight Technologies filings available on SEDAR+. We undertake no objection to update forward-looking statements except as required by law. The Canadian Securities Exchange has not reviewed or approved the content of this webinar. Perfect. I think we can begin. If anyone else is joining, there might be some more people joining from the wait room. We'll let them come on in. But to be mindful of everyone's time here on Friday afternoon, I'll pass it off to VST CEO Shafin Diamond.
Thanks, Abby, and happy Friday, everyone. Thanks for joining today. We had a lot of questions that came in, and as most of you can imagine, they were Hydreight related. So I think I'm not going to waste too much time kind of going through the intro that I usually do. I want to be respectful for all those questions and try to answer as many as I can. So I think we might kick into those right away. But I kind of want to first set the big picture. Victory Square is trading at a fraction of its NAV. Hydreight alone is worth about, I think, approximately $100 million to us. And so that's roughly $1 per VST share from just one of our portfolio companies. As most of you who follow Victory Square know, the arbitrage is massive. And I know that most people have noticed the momentum. Both NURS and VST have seen big growth over the past year, especially in recent months and this week. First off, I want to pause to thank everybody. To our long-term shareholders who've backed us for years, and to newer investors who've just joined, we're very grateful. But I want to be clear, we're not celebrating. The job isn't done. Excitement is great, but execution is everything. There's a quote by Jeff Bezos that said it best, always operate with day one mentality. That means staying hungry, staying scrappy, never acting like the work is finished. And that's exactly what we think about at Victory Square. It's still day one. And here's the key. We don't play fair. Hydreight gives us an unfair advantage. We've got a nationwide physician network, over 3,000 nurses, pharmacies dispensing in all 50 states, medical spas and clinics across the country, tech, and a patient distribution engine. Every new company we launch, whether it's INSU in diabetes care or Pausible in the pet wellness space, plugs directly into that system. That stacks the deck massively and increases our odds of success. And we're also unlocking hidden value by monetizing non-core IP. If you follow the story of the past year, we've had assets that really haven't cost us anything, that we weren't really working on, that have been sold for millions. Last year, we sold IP to a public company called Edge.ai for around 1.7 million. I think in an all shares transaction, those shares are actually trading above what that purchase was, and the stock is liquid. Recently, we sold IP to a company called Yocal.ai for around $900,000. That's going to be listing, I think, in the fall. And we have another transaction of IP that we've had in the Web3 space sitting around that we're going to be in the process of selling to another company that's going to be listing. So that's real assets recycled into high conviction bets. That's the flywheel. Place bets, use unfair advantages, unlock hidden value, scale, spin out, repeat. Hydreight proved it works. Now we're running the same playbook again with INSU, Pausible, and kind of beyond that. So I want to get into the questions. Again, I repeat, a lot of the questions were Hydreight related. So which is good because, again, as everyone knows, Victory Square has a significant ownership and operational involvement in Hydreight. So the first question reads, with Hydreight guiding for 400,000 orders by year end, how confident are you in hitting that number? And what gives you conviction in the back half ramp? I think that question is referring to the order forecast for December of this year. We're very confident. I've said this before, why? Two reasons. First, new high volume licensees are onboarding right now. Uh, we've started to see the pilots in Q2 and Q3. Q4 is when they hit full stride. Second, the pharmacy and tech infrastructure is already in place to handle that ramp. Uh, and the kicker, management wasn't just confident in the 400K per month by year-end order count. They've continuously confirmed the 1.3 million order goal for this year. Why? Because the licensees that signed on were already processing that kind of volume outside the system. So it's just about migrating those flows onto VSDH1, which we expect to be fully transitioned by December. So management is confident in their forecast, and I think they've kind of reaffirmed that on their webinar. So 400,000 orders by December isn't a dream. Contracts are signed, licensees are already doing that volume, and the hockey stick is coming in Q4. Can you clarify how top-line revenue, GAAP revenue, and order volume tie together? And how should investors be tracking growth? Top line is the full order value through Hydreight. GAAP is the net portion we book according to IFRS accounting. Both are growing by 30% year over year. That's in our Q1 and Q2 filings. Investors should track GAAP for the reported financials, but top line and orders show you the true adoption curve. One other metric, which is, I'm hoping we're going to have enough data to share as the year goes on, is LTV, which is the lifetime value of that customer. A lot of people have been looking at the average order volume, which I think is a question later on, which I'll go more in detail to. But also tracking a number that we're hoping to have better guidance on closer towards the end of the year is the lifetime, the LTV of the customer. So anyone that's reviewed our Q1 and Q2 financials, GAAP proves we're profitable. Top line shows how fast adoption is exploding. The next question, you've recorded 3 straight quarters of positive adjusted EBITDA. How sustainable is that profitability going forward? It's sustainable and scalable. We've proven that the model works, and now with margin expansion from pharmacy ownership, profitability has an even stronger foundation. This isn't one lucky quarter. This is the business model working. Anyone that's followed the story or looked at the financials on a quarter-by-quarter basis, year over year, I think you've noticed that, that the numbers have continued to improve consistently. We just haven't had one quarter. It hasn't been just one quarter or half a year or a year. This has been consistent for 4+ years. We're not a story stock. We're a profitable growth company. Recent news to what I think kind of validate the fact that we're even heading into that direction in even stronger fashion, which was the Perfect Scripts announcement, which closed earlier today or earlier this week. I think there's another question on that too, so I'll probably go a bit more deeper into that later on. Oh, this is the question, I think. The next question, how do you expect the Perfect Scripts 503A pharmacy transaction to impact margins, both short-term and long-term? It's a margin reset. Baseline margins, I think management had communicated were around 20%. The Perfect Scripts integration pushes us north of 30%. In the short term, you'll see incremental improvements as the integration kind of kicks in. Long term, it's a structural change in how Hydreight makes money. Perfect Scripts takes us from 20% margins to 30+% margins. That's why the pharmacy ownership is a game changer. What's the cadence of revenue growth investors should expect uh, between Q3 and Q4, given seasonality and licensing onboarding? Q3 is steady. Q3 was a big jump for us from any other quarter we've had, um, showing consistent growth. I would say not showing consistent growth, showing significant growth. Q4 is the fireworks. Anyone that's looked at the forecast or kind of listened to the webinars or followed the story knows that Q3 and Q4 are kind of the coming out party. Shane's mentioned this, and Q4 is really the fireworks. That's when the high volume licensees hit full stride. I would almost think of Q3 as the warm-up lap and Q4 as the hockey stick acceleration. Next question. Baseline margins on VSDH1 orders have been around 20%. With pharmacy ownership now in play, how far north of 30% can you realistically get? 30+% is absolutely realistic. I would say the drivers are pharmacy ownership, white label partnerships, and cross-selling add-ons. Each lever improves our economics, and together they take margins to another level. So margins aren't stuck at 20%. And with pharmacy ownership, they're marching north of 30 and beyond. Again, not to, to beat this, beat a dead horse, but the pharmacy transaction is a real game changer. And there are other, I think in the last webinar, management mentioned that there was the Perfect Scripts announcement was around a 503A. We're also, I think management communicated that we're looking at a 503B, which again would continue to compound the margin improvement and defensibility of the company. And there's also something called a 503A compounding. So margins have improved with the Perfect Scripts announcement, and I would only imagine them to strengthen. I think I kind of answered this next question. Beyond Perfect Scripts, are you exploring additional pharmacy acquisitions, either 503A or 503B? Yes, actively. Management, Hydreight management in their last webinar, I think kind of outlined this, Perfect Scripts was just one step. We're currently in discussions on both a 503A compounding pharmacy and a 503B. Each deal gives us more control, higher margins, and a stronger moat across the US. I would look at it as Perfect Scripts was the appetizer. More pharmacies are on the menu, both the 503A and 503B. How do you balance capital allocation between pharmacy ownership, technology development, and M&A? So this is a very specific question towards Hydreight, but to kind of keep it simple, I would break it down into three things. Pharmacy for margin expansion, VSDH1 for scaling for revenue, and then strategic tuck-ins for defensibility. Every dollar we deploy has to make Hydreight more valuable and push shareholder returns higher. So every dollar goes into one of these three buckets: margins, scale, or tuck-ins. That's it. How many licensees have been onboarded to VSDH1, and what are you seeing in terms of early order flow from these groups? So we've had inquiries in the thousands, and I think that was more so contributed to some of the FDA news around the compounding pharmacies. I think there's been waffling there for I think since November of last year. So there's been a ton of inquiries. Obviously, we have a very strong vetting process. I would say that I think about 700 have been accepted, and I think roughly 400 plus have been onboarded. But the priority for the company, I would say over the last 4 or 5 months, has been onboarding the high volume licensees first, because that's where the bulk of the orders are coming from. The early flow is strong. It's sticky. Once a licensee plugs in, they don't unplug. And with hundreds more in the queue, the growth curve keeps steepening. And if you think about this, the licensee is moving all of their patients into our medical network. And That process takes a bit of time to integrate because you're looking at new physician, new pharmacy, new prescription delivery mechanism. And so it's very hard to move it out. So it's a really big, it's very sticky for us. And one of the interesting things I mentioned earlier about this concept of the LTV, the lifetime value, once the patient comes on board, a lot of the products are recurring products that you kind of stay on indefinitely. And one of the big benefits for both the licensee and for us is once a licensee brings their patient onto our system, uh, that licensee might only have access to like one product that they're supplying that patient. But when that patient comes on to our network, that licensee has the ability to offer multiple products to that customer and patient. So it becomes very, very sticky once they're onboarded, which is great from a defensibility perspective. And this LTV idea again, it's very valuable for our the higher and stronger the LTV, the stronger the value of the enterprise value of Hydreight becomes, and the higher the value of the VST equity ownership of Hydreight becomes. What's the average order value trend? Are there initiatives to push the AOV higher? So I think Hydreight management has communicated that they want to wait till the end of September, which I think would provide them with enough data to be able to have a better gauge on what this number is. I think that in their previous webinars they've talked about $40 to $60 or $60 to $80, but I think that's just the starting line. Um, uh, you know, Really that end of September will give us 3 months of really strong data, which will give us a clear view. But the way I look at AOV is kind of tied to the LTV argument or LTV idea, which is the way we grow the AOV is simple. As an example, a patient starts with a genetic test. AI analyzes the biomarkers, and then we give that patient a personalized health plan that evolves over time. That patient adds more services. So as an example, what we are seeing in the male patient trend is they might start with weight loss. They lose weight, they feel a bit better, then they move on to TRT. TRT makes them feel better, then they might tackle hair loss. They tackle hair loss, they might be dating a bit more, they might tackle ED and peptides. So the beauty is that most of these treatments are recurring and they're ongoing forever. So, $60, I think I'm trying, I don't want to speak on behalf. I think in the last webinar, I think they touched upon a $60 number, or Shane might have mentioned $60. It's the starting line. And I think as patients and genetics, TRT, ED, hair loss, peptides, the AOV only goes up, and most of it's recurring forever. But it really ties into this important, to me, of an even more important number, which is the LTV, which is the lifetime value of that customer. Hydreight started with GLP-1s, but where do you see the VSDH1 platform going next? How do you expand into new areas? So GLP-1s were the wedge, the hot entry point, but the platform is modular by design. We've already started layering in hormone therapy, anti-aging, genetic testing, at-home diagnostics, NAD+. Um, that means once the patient comes through let's say via GLP-1 weight loss product, we can expand their journey across 5, 10, 15 different health verticals, all under the same roof. So that multiplies revenue, retention, and stickiness. GLPs in a lot of cases got us in the door, but VSDH1 is the whole house. Hormones, anti-aging, genetics, diagnostics. Shane has mentioned it's a full digital health ecosystem. Are you seeing any demand from other healthcare or wellness brands to white label the VSDH1 platform? Yes, and it's stronger than we expected. A lot of brands don't want to spend years building a 50-state doctor network, nurse coverage, compliant pharmacies, and continue to monitor that, on a month-to-month, quarter-by-quarter basis. It's expensive and slow. With VSDH1, we can plug them in overnight. They keep their brand, we provide the rails. It's win-win. They scale faster and we monetize their volume. Dr. Frank's is an example of that. And again, we're getting a number of other companies reaching out. Brands don't want to build the infrastructure. We already did. So VSDH1 lets them white label healthcare in 50 states instantly. What's Hydrate's M&A strategy for the next 6 to 12 months? Where are you focused? Pharmacies, tech, or revenue businesses? I'm smiling because these are all Hydrate questions again, and apologize. I mentioned that there are a lot of Hydrate questions here, but I feel like it's important to answer them for VST investors, given how our ownership stake and how actively we're involved on the operational side. So, uh, what's Hydrate's M&A strategy for the next 6 to 12 months? Where are you focused? Pharmacies, tech, or revenue businesses? I would say all three. Pharmacies for margin expansion, like we mentioned with the 503A announcement with Perfect Scripts. We're also looking at a 503A compounding and 503B. Two, the tech and IP, which I think strengthens our defensibility. And then revenue businesses, things like single product companies that explode once they're plugged into our platform. So the example I gave earlier in one of the earlier questions is a licensee might come on and only be offering one product to their patient, but that patient, like in the mail scenario, in mail example, could use multiple products. So we're enabling that licensee to sell multiple products to that one patient, increasing the average order value, increasing the LTV. So those three buckets, I would say, are pharmacies, tech, IP, revenue brands. We buy real businesses, plug them into our 50-state machine, and scale. And to note, we're not buying science experiments. We're buying real businesses with customers and cash flow, and kind of supercharging them with our unfair advantage. How do you cross-sell opportunities when you plug a single product company, like one only selling GLP-1s into your platform? I feel like I kind of just answered this, but that's the magic. A GLP-1 only company is a one-trick pony. You plug them into VSTH1 and suddenly they can offer 10 plus products. I mentioned hair loss, TRT, ED, peptides, anti-aging, diagnostics, genetic testing. That immediately increases their revenue per patient and their customer lifetime value. And because we own the rails, we share in that upside. When you look at M&A, how do you evaluate multiples, given that many of your targets don't own their IP or tech? This is a great question. I would say businesses without IP or tech usually trade at around 1 to 2 times revenue, which is very cheap. So that's the valuation and multiple that we get to see. Once we plug them into VSTH1 with nationwide infrastructure, tech, compliance, and cross-selling opportunities, that multiple re-rates to 5 to 10 times. That's the arbitrage we're capturing. Buy low, integrate, scale, re-rate. So we look to buy at 1 to 2 times. Once plugged into our machine, they're worth 5 to 10 times that. That's pure multiple expansion. How big is the total addressable market across Hydrate's three verticals? And where do you see your share trending over the next few years? A lot of this information might be better to look at some of the news releases because I think we've sourced some of the numbers. But high level, I mean, the US digital health market is a multi-trillion-dollar market. I think Shane had mentioned in one or two of the webinars that it's a 4.5 or $5 trillion market in the US alone. Just the three verticals that we've talked about, telehealth, pharmacy, and wellness, I think add up to hundreds of billions. Hydrate's footprint today is a fraction of that. But with this order goal of 1.3 million orders this year, and ending the year with 400,000 orders in the month of December, and ramping up with 30% margins and national coverage, I think our share is going to continue to grow every quarter. I mean, the TAM is massive. It's in the hundreds of billions. Right now, we're at a fraction of it, but every quarter, our slice gets bigger. And that's just based on looking at our quarterly numbers that have been released. You'll see that growth has just been phenomenal quarter after quarter. And Q3 and Q4 of this year, I think are primed to be our biggest quarters ever. Who do you see as your biggest competitors, and what's Hydrate's defensibility moat? So competition is fragmented. Some players do telehealth, Some do pharmacies, some do clinics, but very few do all under one roof. Our mode is unique. We've got a 50-state physician network, 3,000 plus nurses on the ground, nationwide pharmacy distribution, bricks and mortar clinics in all 50 states, and a tech platform tying it all together. I know Shane has reinforced this point that our moat is this compliance moat we have because for this infrastructure we've built, or the team has built, for others to do it, it could be very costly, and it could take a lot of time. The combination is almost, I don't want to say impossible, but it's very timely and costly to replicate, and it's why we keep winning. So as Shane has mentioned, our moat is our 50-state coverage, our doctors, nurses, pharmacies, clinics, and tech, all under one roof. Very few, I don't know of many companies that can say that they have all of that. How do you see AI changing scalability and efficiency? Um, a- AI is a huge unlock. I feel like the word AI has kind of become a buzzword and it's thrown around in a lot of different cases. I think where it becomes valuable and applies to us is there's a tremendous amount of data, whether it's data from our spas and clinics, whether it's data from the work that the nurses do, whether it's data from the licensees. There's a lot of data there. Um, you know, I mentioned earlier the example of the genetic test or the biomarker test. You know, the AI that we're using and incorporating can help analyze blood panels, those genetic tests, patient data, so that the clinicians can move faster and more accurately. It means, lower cost per patient, faster onboarding, more scale. Um, Imagine the efficiency of Uber combined with the personalization of healthcare. That's where AI takes it. So for us, it's not just a buzzword. We can incorporate it, where we have data. We can incorporate it to optimize workflows and processes, and significantly um, uh, allow our nurses, our physicians, our clinics to be more cost efficient, using some of the tools. What's phenomenal there too is there's distribution, right? So not only do we have a massive data set, but we have distribution. So it's not like us saying, hey, we've got this AI tool. The AI tools that we've built, or are looking at acquiring, are based off of the needs of the ecosystem. So we're able to immediately plug them into the ecosystem and create efficiencies and generate revenue and profit for the company. You just closed an oversubscribed $11.5 million financing. How do you plan to use those proceeds, and how does this set you up for uplisting? So this question is in reference to the announcement yesterday on Hydraight's $11.5 million convertible offering that was oversubscribed, led by Canaccord. We've talked about this. I think that the use of capital kind of ties into three use cases. One is pharmacy investment ownership. Perfect Scripts, was one of those announcements, which was an all stock kind of transaction when that was done. And there are a couple of others that the management mentioned in the last webinar. So I would say that is one of the uses of funds. The second is scaling VSDH1 licensees, fueling them for growth. So whether it's the improvement and optimization of tech, or there was an announcement in a previous Hydreight webinar where we talked about creating our own, launching a marketing agency that we could help our licensees generate more leads, which again, all plugs into our ecosystem, or providing certain debt financing opportunities to them to accelerate their marketing campaigns, if they're optimized on, let's say, a Facebook or TikTok or Google Ads. And the third, I would say, select tuck-in acquisitions. Management did mention that there are a couple of, whether it's the pharmacies, tech, medical IP, and other M&A kind of tie-ins in their last webinar. I would say select tuck-in acquisitions would be the third. More importantly, it just strengthens the balance sheet as we prepare, whether we uplist onto the TSX and in the NASDAQ next year. These financings have allowed us to increase our institutional base, get analyst coverage, which I think more is to come. get us onto more radars. I think it's just kind of been a domino effect of positives for the business to really kind of accelerate and take advantage of this momentum that we have. Hydreight has grown top line from $1 million in 2020 to $22 million in 2024. How do you bridge that trajectory forward to a $100 million plus revenue company? I got to be careful how I answer this because I don't want any forward-looking. I don't want to, cross any hairs here. But I think it's the same playbook, just bigger. Going from 1 to 22. Now again, next target, aim for 100. I think the levers to achieving that are kind of clear. It's you hit your order numbers, you maintain your AOV, obviously being built up towards a high LTV. You work on optimizing your margins because it's not just enough to have revenue. You want to optimize your margins and have profitability there. Driving white label partnerships, driving volume, cross-selling multiple products per patient, more pharmacies integrated. You put all of that together, I feel like the path to getting that number is right in front of us. We've kind of followed that path to go from 1 to 22, and it's a very similar playbook to go from 22 to 100 or to go to 100 to a billion. Uh, the path is there. You just have to execute on each of those items. And I feel like the company has been doing that, delivering results quarter after quarter, but also operationally, like really being focused on responsible growth, like being fiscally responsible, structuring good deals, bringing the right financing partners on time, bringing the right partners on time, looking at the 503A, the 503B, the comp, like every move, I think strategically, has positioned us to have this process that if we follow and we execute, it's achievable, and not just an aspirational achievable. It's like you can look at the steps and kind of reverse engineer how we get there. So I would say that 1 to 22 is just the beginning. The order count for this year, the 30% plus margins, the white label cross sell, the pharmacies. This is how we get to those $100 million plus kind of revenue numbers. Can you remind us of how much of Hydreight VST owns today and what the position is worth? So I think in our Q2 financials, which are as of the end of June of this year, I think the ownership number was around 58%. It was a controlling stake. I think it was around 25.5 million shares. I don't know what the stock is trading at today, but I think as of yesterday, that could be around $100 million in value. But what's important to note is that's just one company. I believe our NAV, our unaudited NAV, is approximately around I think it hovers between around 150 and 164, 150 million to 164 million. That range is just there are a couple of transactions right now that are kind of going through financings, and so that number might flip. Obviously, the largest portion is allocated towards Hydreight. And to put this in context, I think our share price closed yesterday at around 61 cents Canadian. I think we have roughly 100 million shares, so that would give us a market cap of around 61 million. So obviously a huge arbitrage opportunity there. What's happening with INSU Therapeutics, and why do you see it as such a priority? So INSU is a spinout out of UBC, which is the University of British Columbia. This is a really prominent university here in Canada, and it's a prominent university with respect to the life sciences space. And INSU's tackling a massive problem. They've been working on a patent pending oral insulin tablet. So it uses a buccal delivery system where you put it into your cheek, and it's designed to mimic the body's natural insulin pathway. So inner cheek to the liver. Their early preclinical work, had shown significant insulin uptake comparable to injections with improved liver targeting. This is the kind of breakthrough that can change daily life, for people living with diabetes globally around the world. So the addressable market is significant, and there's a strong why. When you think about diabetes in, let's say, a country like India or in a country like Africa, one of the challenges with, currently is that insulin needs to be refrigerated, and there's not consistent electricity supply in some of these regions, or even refrigerate, and it needs to be refrigerated, or refrigeration for that matter. Then you look at the amount of plastics in the ESG, kind of waste. The other big thing is one of the things driving the founder of this was that he had a young niece that had type 2 diabetes and had to inject herself every morning. And so you think about not only is the addressable market significant, but there's a number of pain points that this could be, game changing for. Now, it's one thing to tackle a significant market opportunity. The other is who is leading that charge. And I think the team is the real edge. Um, the founder, Dr. Anubhav Pratap Singh, he's a professor at UBC. He's got a number of patents. He's been written up on a number of different medical journals. He's super sharp. Led by him, strong why. He's got the academic background. He's got the experience and history of applying for other patents and getting them approved. Ahmad Shorbaji, which is another co-founder, we've worked with him for years as well. He's a former VP at Sanofi. Again, he championed their M&A strategy. So what happens in a lot of cases is large pharmaceutical companies don't innovate; they go and acquire these types of companies that have gotten momentum or getting towards completing or two human trials for their studies. And then the other is Dr. Tom Elliott. So Dr. Tom Elliott is one of the leading Canadian endocrinologists. He's the medical director. He runs BC Diabetes here. And then you've got UBC, like I mentioned earlier, on the cap table. This is the same university behind successes such as AbCellera. So really, really, really strong team tackling a really, really large addressable market. One other thing I would mention too is that pipeline-wise, INSU's platform isn't just one asset. It's expanding across multiple peptide or injectable categories. So I talked about insulin, which was how it was founded, but there are 8 other injectables that this technology can be incorporated to: GLP-1s, TRT, and with an FDA, 505(b)(2), path and first in human trials targeted for 2026. Imagine plugging all of that into Hydrate's 50-state physician network, 3,000 nurses, pharmacies, compliance, distribution, and you've got an unfair advantage for speed and scale. So, insulin was the primary focus, but the patent applies to, other injectables, which include GLPs and TRTs, GLP-1s and TRT, which again could be, plugged directly into, Hydrate's ecosystem or VSTH1's ecosystem. Can you give us an update on Pausible Ventures and how it fits into the VST portfolio? So again, Pausible, I've heard some mention Pausible as Hydreight for pets. Pausible, the target is the $130 billion pet wellness space, with AI, to disrupt it with AI and tech. Alex Chang, who's the founder, previously founded a startup in the pet health space, which he sold, called Vetsy. He's built real partnerships. He's got relationships with Mars Pet Care, which is one of the largest pet companies globally, Merck Animal Hospital, and Animal Health. His previous project, Vetsy, was strong because it was accessing the data set of all of the Merck Animal Hospitals, which allowed it to create really, really good tech for the vets that licensed it. And he's got relationships with a number of vet organizations, groups, and VCs that invest in the pet health space. Just to note, he was also named a winner of one of the world's largest AI hackathons, I think a month ago, which was run by Bolt. So huge validation of his product chops. And similar case with INSU, Pausible doesn't start at zero. It can plug into the VSTH1 Hydreight infrastructure, so it can scale faster than a typical startup. And the IP that Pausible builds or invests in can also benefit off of that. One of the catalysts to really pushing forward on Pausible, other than like the market opportunity and being able to collaborate with Alex, was a couple of months ago, ran a survey within our VSTH1 Hydreight ecosystem. So when you think about it, you've got, I think, pet ownership in the US, I think, is around 55%. So this will be focused on the US and Canada, but primarily the US. So you got 55% pet ownership. So the nurses, the doctors, the clinics, the pharmacies, the end patients, you've got this built-in network of people that are in the healthcare space, whether it's the patients spending extra money on their own health and wellness. The reality is most of them own pets and would, and in the survey that we did, would spend money on their pets when it comes to health and wellness. Whether it's, today we looked at Alex and I looked at a project within the pet testing space to identify biomarkers within the pet, so that the pet owner could be proactive as opposed to reactive if something were to happen to the pet later on down the line. Uh, Guts, supplements for pets. And so there are a number of different really interesting. Sorry, the biggest one to me, which was the most exciting, is the pharmacy opportunity within the pet care space. If as humans we go and see a physician, and then physician gives us a prescription, and then we go into a pharmacy to dispense it. For any of you that have pets, like, you go and see your vet, and the vet not only prescribes, but in most cases dispenses. And so there's very, poor consistency along pricing, and the margins are a little bit crazy. There's a huge opportunity in that category. And that's, again, another big advantage for us, being in the 503A compounding, which is what we're looking at in the 503B space, because there's a lot of similarities between human meds and pet meds. What's the latest with VRAI in Game On? I was waiting for one of these questions. Are they still core holdings, or are you reevaluating them? I don't really have any new updates on Game On. I apologize. But on VRAI, here's what I can share. They should be back trading shortly. Um, I'm coming on and have been supporting them as a special advisor. It's a big holding for VST. Um, Going forward, again, just given the momentum we have in the technology space, we've been working with them to focus on their tech use cases within the healthcare space, which we've been really, pushing, I would say, over the last 6 to 8 months. Actually, sorry, longer than that. Specifically, their digital twin technology that creates immersive simulations for training in healthcare. So anyone that's followed the XR Immersive story, it had built immersive experiences that were initially primarily being used in entertainment, but a lot of those technologies have similar applications within the healthcare space, as well, whether it be monitoring, with monitoring technology, which we've been piloting in specific health use cases. So the tech applications are in areas such as surgical training, diagnostics, even patient monitoring. So while VRAI has had challenges, there's still a real opportunity there, and we're going to work with them to execute on the health tech side. So Game On, I don't really have much to update on right now, but VRAI is should be trading soon with health tech, with the digital twin technology as their focus, and I think that's where the upside is going to be. There's been some chatter around VRAI's debt liability. Does that roll up to VST? Nope, that liability, I've said this before, sits with VRAI directly. It doesn't roll up to VST. We're not responsible for it. We're just shareholders. We are not guarantors of that. Having said that, I've been working with the debt holders of VRAI to convert all of that debt into equity at a premium, significant premium to today's share price, because I believe the underlying tech that sits there is more valuable than the share price would reflect. And it's a win-win. So it cleans up the balance sheet and aligns everyone for growth. So VRAI's debt is not VST's, and we're looking to convert VRAI's debt into equity at a premium, and it should be trading soon. With the recent rise in VST and NURS shares, should we expect insider selling? And if so, how should investors think about it? This is a fair question. So I think for both VST and NURS, there's been some minor sales by directors at both companies, I think, in the past year. It's natural. uh, I don't think VST had an insider sale for like 3+ years, maybe even longer than that. And I think similar in the case of Hydreight as well. So we've all seen the share prices, appreciated, significantly within the past year. Just as a reflection, September 3rd last year, Hydreight was at 24 and a half cents. I think VST would have probably been around 10, 11, 12 cents. So significant growth since then, significant increase in interest and liquidity. So I think that it's normal. It doesn't really phase me if certain insiders if there's certain insiders selling, but I don't imagine that to be significant or problematic. One thing specifically for NURS though, uh, this last financing that we just announced yesterday, the closing of it, NURS directors and officers are locked up for 4 months under the recent financing. So I don't expect to see anything from NURS, but with VSC, you might see some insider selling. But to just reiterate, I will not be selling. I'm fully aligned with shareholders, and I believe the growth is ahead. I'm speaking if there are, like directors that may have small portions that haven't. Do you anticipate VST selling any of its Hydreight shares, especially with the debt conversion we've heard about? So just to clarify, the debt conversion. So I think in 2022, and this was prior to NURS going public, VST had announced we had taken on about $2 million of strategic debt, at the time because we did not want any dilution at those prices. Um, I think the balance of that debt was sitting at around 1.6 million, and the lender had the option or has the option to convert into NURS shares at a 20% discount to market. So this was done in pre-NURS listing, I think in 2022, and I think I might have mentioned this as well, that VST's current ownership, I would say, of NURS shares is about 25.5 million, roughly. I've mentioned this before that there might be, approximately 2 million NURS shares that VST owns that might be, tied into, I would say, potentially this transaction and or performance options that NURS and or certain VST consultants may have that were all created prior to NURS going public in 2022. So VST does not intend to sell any of its shares, but I would imagine, and I've mentioned this before, that there's probably around 2 million shares that, in the case of the debt conversion, might be around 600,000 shares roughly, I think. And then there could be a balance that would be shares that either NURS and or team management or people involved in the go public listing could their share purchase right options, which might be, I think, there's a strike price on them, but that would be it. So VSC doesn't intend on selling anything, but as I mentioned before, there could be up to 2 million shares, I think, that would go there. And one thing to note as part of that too, in January, I kind of mentioned one thing, which one of our goals was this year was to kind of strengthen the VST balance sheet, and to completely be kind of debt free. We also the other main priority was to create cash flow and income, which the intention was to come from the VSTH1 payments that the VST would get. One other thing too, just to mention, and I've said this before, for years, that VST has a strategy, and in the big picture, the strategy has not changed. We generally, when we make an investment, whether it's within 1 year, 3 years, 4 years, 5 years, our goal is to try to take out our principal, so whatever we paid for it plus 20%, and then hold the majority long term. So this is also one thing I think we kind of try to keep discipline to that, and generally that capital coming back could be used for redeployment. But to reaffirm, VST is not planning on. There's no intention of selling NURS shares. I think we currently have around 25.5 as of June. If anything, we've talked about this. There could be about 2 million shares that would be tied into either the conversion of debt, which is great because then VST's debt goes to zero, or two, performance warrants for management on the NURS side, and others involved in that again would be rightfully so given, and they have a strike price, rightfully so given how well the asset has performed. You've mentioned selling some non-core IP. Can you give examples, and how does that fit into your strategy? So this is one of the, I would say, the coolest parts of our model. A lot of people don't really kind of pay attention to this, but we sometimes develop or pick up IP that doesn't fit our core strategy, and it kind of sits there. And instead of letting it sit on the shelf, we monetize it. I would say recent examples for anyone that's followed, VSC sold some IP that cost us nothing and was sitting on the shelf we sold it to a public company called Edge AI, and we took shares. And I think that transaction we sold was around 1.7 million. We got flack for taking shares. The shares are more valuable now than that number, and they're liquid. So that was one transaction. There was one more recent. I think it was in Q2. We sold some IP for just under $1 million. I think it was around 900K, again in shares, for a company called Yocal.ai, which is going to be public, I think, in the next couple of months. Again, IP that we'd had in the fintech payment kind of space that wasn't doing anything. We were able to monetize it. Again, doesn't show up on our balance sheets, but it's IP that's sitting there. And then we have another one that I've been working on in the Web3 crypto space, which I'm hoping to close within the next 30 days, which should be for around another $1 million for another public company in the treasury space, in the crypto treasury space. Hopefully, that's going to be listed by Q1 of next year. Just looking at those three examples, that's like roughly $3.5 million of unlocked non-core assets with zero carrying cost. And our goal is to again recycle any of those gains into new IP, or plug it into projects like INSU and Pausible. What's VST's strategy for driving shareholder value going forward? Is it dividends, buybacks, or purely NAV growth? Our number one focus is closing the gap between the NAV and the market cap. Today, our NAV sits roughly between 150 and 164 million dollars, but the market values us at a fraction of that. So our playbook, again, monetize wins like Hydreight, take advantage of the fact that these assets are grown. Really, we've gained a new investor base because of new eyeballs on Hydreight, whether it be retail or institutional. Even a lot of the analyst coverage is coming on to Hydreight. So, on Hydreight has been coming on to VST as well. And people are seeing that ARB up. And so really kind of leveraging that momentum that Hydreight has. The second, surface new outliers like INSU and Pausible. And also, again, be very judicious with recycling capital into, that next generation of bets, but primarily focusing those bets on areas where we have an unfair advantage. And most importantly, we've been exploring, and I'm really thankful to a number of our shareholders, especially on our Discord channel. I'm going to butcher the Cryptic Enigma and Uzo, for really good discussions and feedback, and others around the share buyback. This is something that I mentioned in our news release, and we are exploring now, where I think it's something that would be wise for us to do, given that there's still a significant ARB. And again, I think it shows the market too, and that we as a company believe that it's undervalued. So the buybacks is a tool that we're strongly considering right now. When you sell or monetize assets, how do you decide where the cash goes? What's the capital allocation strategy? So right now, the previous examples I kind of mentioned uh, were all kind of related to share transactions that we had done. So uh, in each of those transactions, we're doing those transactions, A, because we're monetizing an utilized asset, but we also see something in those three initiatives. And so for us, we also want to have anchors and bets in multiple categories. So I think one is, from an ROI perspective, is we want to see those, increase in advance, over time. Uh, and in the other example, I kind of reference with, let's say VST and Hydreight shares, we want to preserve those shares because we believe that, as Shane said, you haven't even seen growth yet, as that growth is still ahead of us. Um, Obviously, that in that transaction, though, with the strategic debt, it's a small number of shares, gets our balance sheet completely wiped and clean. So I'd say right now we're not really looking at huge liquidity type of events. And when we do, we're generally looking at the right fit to be able to take some shares or some equity where we think someone else can take that IP and get a significant ROI um, on it. Uh, with respect to INSU and Pausible, VST was there from ground floor, so we got equity at significantly discounted values. And now to grow those projects, there are other investors that have shown significant interest where we're able to finance those projects at significantly higher valuations than our entry point to help and grow them. So it doesn't require any capital from VST. And I think for us, the goal from let's say a cash distribution perspective back to investors, I think that's where we would look, that if we saw a significant exit opportunity, the purpose would be to take advantage of that to pay out a cash distribution. So as you've seen, VST doesn't really require a lot of capital to operate. When we make investments, we're so early that it's not capital intensive. If the capital intensive portion comes, we're able to finance those businesses separately at a higher valuation. Uh, and so, you know, if there ever were to be, a large liquidity event, as the largest shareholder myself who doesn't sell shares, the goal would be, I think, to distribute those to shareholders. The NAV discount on VST has been huge. How do you close that gap and get the market to recognize the value? This question came up earlier. I mean, this is the billion-dollar question, right? Holding companies trade at a discount, yes, but ours is outsized. Um, I think the way we close it is through um, is to continuing to do what we're doing. And I think the biggest catalyst for us has been Hydreight. So it's a fact that all of the renewed interest or all of the new interest in Hydreight has reflected positively on VST. Uh, we've gone from 10 cents a share last year to, I don't know what the share is trading at right now, but yesterday's close of, let's say, 61.5 cents. So um, if the portfolio companies do well, or then I think that brings a positivity towards VST as our portfolio companies get analyst coverage, as in the case of Hydreight, that puts VST on the radar. So we've been able to attract new investors through Hydreight, new coverage through Hydreight. And I think that's going to continue to grow because as Hydreight grows, we've seen the direct impact it's had on VST. And I think we can expect something similar, maybe not to the same extent, but something similar with investments like Pausible and INSU as they list. So, and I think one other thing too is that, and investors, VST investors that have been following our story probably have heard me say this a year ago, or 2 years ago, maybe even 3 years ago, that our strategy was, the reason why Hydreight was spun out is that we were realizing no value of it under VST as most of the portfolio companies that were or are still in VST. And so the idea there was spinning it off because A, we can maximize the true value of it. Two, people that may not get the VST holdco story at the beginning might be a healthcare investor and understand that the Hydreight story, and that's how we get introduced to VST. It also allowed us to be at conferences without having to pay for being at conferences, and really leverage a lot of the momentum that Hydreight has. So looking 12 to 24 months out, what should investors expect for VST in terms of growth and catalysts? I would say here's what's on deck. One, Hydrate's a priority. Hit those growth targets, hit those margin targets, hit our revenue targets, and continue the momentum and scale execution on the 503A, compounding 503B, execute on the new software tools, execute on new IP, execute on the tuck-ins. That is what's on deck, and that, to me, going into Q4, September is the end of Q3, but then going into Q4, I think there's tremendous momentum there. INSU, progressing towards their first in-human studies with the patent pending oral insulin. Plus, we've already started to work on some of the additional pipeline of injectables like GLP-1s. The other is Pausible, Pausible, really accelerating with Alex on the AI and vet tech, playbook. So Alex, I think, is mentioned on our Discord channel. He's got a number of updates from September to December coming out, so stay tuned. And I'm hoping to have a webinar with him very shortly. The NAV unlocks, so those IP sales I've mentioned, one which I think their stock has been performing well, which is Edge. Yocal and the Web3 project we're expecting listing soon as well. And so I think those would be catalysts. And then I think one other big thing is to keep an eye out for, like I mentioned earlier, we have been strongly exploring the VST share buyback and hope to enact that, shortly. So, the flywheel is running, find winners, plug them into our unfair advantage, scale, spin out, and recycling. So the next 12 to 24 months, I think, equals Hydreight scaling, INSU advancing its oral insulin, patent and other injectables, Pausible tackling the $130 billion pet wellness space, and share buybacks and more NAV unlocks. I just noticed we got to an hour. Before I wrap up, I kind of want to just summarize the big picture for investors. VST makes big bets for asymmetrical upside. Some will strike out. As we all know, there were some duds or one, big dud last year. Some will be doubles. But the goal is to surface the outlier. Hydreight is that outlier. We've gone from 1 to 22 million at the end of last year. Profitability, scaling it to this target of 1.3 million orders this year and ending the year, with 400,000 orders in the month of December, on a significant, 9-figure trajectory. We don't just make bets, we stack the deck. Hydreight gives us that unfair advantage. We've, the nationwide network of doctors, nurses, pharmacies, tech, distribution. Every new company that VST looks at in the healthcare space, as an example, whether it be INSU or Pausible, which we believe are the next waves, plug into that ecosystem from day one. So for us, we keep unlocking hidden value, whether it's that or IP that's sitting on the shelf, which we have lots of it. And I gave examples of roughly $3.5 million of non-core IP sales that we just recycled into high conviction bets. Our NAV today sits healthily between 150 and 164 million. Our market cap is a fraction of that. That's the real opportunity for shareholders. So our model is simple. Find the next Hydreight, scale it with unfair advantages, spin it out, recycle capital, repeat. We're profitable, we're in the early innings, and the biggest growth is still ahead. Um, oh, there's more questions here. Okay. Uh, there are a lot more questions. I'm gonna I'm gonna take another. Hopefully, I'm running a bit late behind you, but I'm gonna take another 5 to 10 minutes to just try to knock off some of these. Um, when can you share Hydreight August order numbers? We expect these order numbers for August to be out, I would say, within the next 7 to 10 business days. One of the reasons why they were not out at the very beginning of September is I think that the plan is going to be to wait an extra week or two after the month closes in case there's any chargebacks or returns to just get a more accurate number. So the August numbers I would expect to be out within the next 7 to 10 days. Does Victory Square get 10% revenue or profit share off of each nurse v pharmacy order on the third vertical? Correct. So as part of that, 10% of the profit from VSDH1 goes to VST. Is VST gonna go to a better exchange? Also, why isn't NURS going onto the NASDAQ? Oh, so our first focus will be NURS. So the goal for NURS is to uplist to the TSX Big Board here in Canada, and then to the NASDAQ next year. And if you think about this from a NASDAQ perspective, it makes all the sense. Hydreight is a U.S. business with 100% of its business in the U.S. from its doctors to its nurses to the medical spas to the clinics to the end patients to the pharmacy. Everything is US based. So getting onto the NASDAQ is key because all of those people can buy stock in NURS, and they're all customers or participants in the ecosystem. Some already are, but it would be a lot easier for Americans to buy the NURS stock directly from off of the NASDAQ. So NURS definitely going in that direction. One of the benefits of NURS being on the NASDAQ for VST is that it gives us a lot of optionality with our equity there because having significant equity in a NASDAQ stock also allows us to potentially access debt or maybe favorable debt against it if we wanted to. Not that we want to, but I'm just saying there's lots of flexibility for us from a VST perspective. Now, with respect to VST, once Hydreight makes that leap and we get them set, I think, it would be natural for VST to, to look at, potentially uplisting to the TSX Big Board. But, it was a priority for VST a couple of years ago, but then the markets turned and it just, our focus was the operations, right? At the end of the day, sales will save all your sins. Like take care of the business, the fundamentals, the moat, and then, we can handle that later. When could a potential NCIB take place to help narrow discount to NAV? I would imagine very soon. We've been exploring it and speaking with legal counsel on that as well. So that's something I would expect. Shortly. We are through August now. Can you provide any insight into the August VSDH1 order volume for Hydreight? Any update on how September is shaping up? Like I mentioned before, the August numbers should be out in the next 7 to 10 days. I think it's going to be normal for the numbers for a month to come out, I would say, within 2 weeks in the following month, primarily just to make sure there's no, chargebacks or refunds or returns or any issues, so the number is accurate. From what I can see, September is shaping up to be very strong. NURS VSDH1 order number for fiscal. Okay, so this is a similar question. NURS VSDH1 order number for fiscal end August. Then the other two verticals, thanks. So that, again, like I mentioned, I would expect those orders, that order number for August to be out within the next 7 to 10 days. Excluding the NURS position, what does management feel is the current NAV of the business? Also, how much does management feel the value the 10% royalty is worth? Would NURS be willing to buy it back? So our NAV roughly is our unaudited NAV roughly is between 150 and 164 million. The 10% royalty, I don't really have an accurate value of what I think that's worth now, but I will run that exercise and I can share that answer on the Discord channel. Would NURS be willing to buy it back? We've never had the discussion. So one thing to note, like uh, NURS, NURS is not only VSC's largest holding, but we're actively involved in the business, whether it be chairing the board, operationally. Most people that have tuned into the NURS webinars have seen Vahid on there, or Abby kicking off both the NURS webinars. So this has been one of those assets that we actually kind of operate. So that conversation about buying it back has never kind of come up. Very positive that you mentioned in the last PR that share buybacks are actively being discussed. Could you provide more concrete info on how you will implement this? NCIB or SIB? When will the buyback start? So, like I mentioned earlier, it'll be an NCIB, which we've done previously in the past, and I would anticipate it very shortly. We've had the conversations with legal, so I'll keep everyone posted on that. Please give a breakdown of Pausible. If it's a VC fund, should we only expect a return on capital in 10 years? So Pausible is kind of interesting. So Pausible has been referred to as the Hydreight for pets and also the VST for pets. So with Pausible, we're kind of doing two things. One, we're incubating IP from scratch. So one of the reasons why we referenced Alex winning the world's largest AI hackathon with Bolt is that Alex can build and manage teams to build IP very, very quickly. So one of the things there is to build IP that's wholly owned by Pausible from scratch that can be spun off. Some of the IP that we've been looking at are immediately solving pain points in our existing health ecosystem. So we already know they're going to be commercially viable. So those businesses would be immediately returning value. The second would be investments that we make. So Pausible, because of Alex's relationships with, let's say Mars and their Leap accelerators, Alex has got an eyeball, and he's an advisor there to like pretty much all of the top, because Mars's Leap accelerator, if anyone's familiar with Y Combinator, they're the Y Combinator for pet health. So Alex is seeing all of the IP that's coming into that category first, which is allowing us to not only come in there as an investor, but to say, hey, if we're looking specifically for like companies where there's overlap. So genetic tests, certain supplements or pharmaceutical compounding companies. So when we look at them, we're not only cutting a check to them, we're able to say, hey, we can plug you into our distribution channel and pipeline. So I don't expect the return of capital to be to 10 years. I think with Pausible, our goal is to and Alex will share this. There's some IP that he's built already, which is amazing. And some investments that we're looking to close in the next, I would say 30 to 45 days. When he shares that, I would imagine the next plan for us would be to spin off and list Pausible as its own public company. So again, not waiting 10 years, but allowing for investors to come in and out of that stock based on how it performs. Will there be substantial cash flow from the NURS orders through profit share in Q3? I think this question is probably better answered after the Q3 numbers are in. I do know when we started the year from a VST perspective, I'd mentioned our goal was to clean up the balance sheet and also generate income, not called passive income, but like income coming in. And by the end of the year, that goal was that cash flow was to come from VSTH1. So we do expect that. I just don't know what that specific number is yet. What is expected AOV in Q4? So again, with respect to AOV, I think in the last webinar, I can't remember if the number was 40 or 60. I think Shane or Vahid mentioned it. And I would reference that as a starting point. Now, for us, it's more important to get the order in the system. I'll give you an example. Everyone knows that everyone that's followed the story, NURS story knows that Q3 was the ramp up from an order perspective. So as that ramp up came in, with respect to some of those orders, some of the licensees reached out just to say, hey, we want to run a promotion to get the customer in the door earlier with maybe a 50% off on their first month's order. Can you work with us on that? So for us, it's a no-brainer because we're focused on the LTV, not the first AOV. So I would say that the AOV number, my expectation is it, there'd be a starting point, but for it to grow, and not only just grow on one product, but to grow because of the ability to, sell other products, to it. So, uh, I'm really sorry. I apologize to everyone. I had another meeting at 12 that I've kind of gone over with. Abby, is it possible to copy and paste the questions that I haven't been able to get to, or if they're saved, and then I can this afternoon answer all of them and maybe share it with the Discord? Abby, are you still there? Um, I think Abby's gone. Well, again, everyone, thank you so much for tuning in. I apologize, I couldn't go longer. I'm going to work with Abby to try to get this up, hopefully soon for anyone that's missed it. And then all of the questions I wasn't able to get to, I'll try to share in the Discord channel. Again, thank you everyone for your support. I'm, as like I mentioned earlier, I'm happy that the share price is appreciated for both VST and NURS, but for us, it's day one mentality. We haven't, as a management team, achieved anything yet. Our goal is to continue to keep our heads down, execute, to really kind of realize the opportunity we have here. So thank you, everyone. Happy Friday, and have a great weekend.